Hi there, I'm Gerard Vecchio. I'm a managing director here at MarshBerry, and we're here at our Peak Performance Summit Conference. I am here with Pat Rastiello from Price Forbes, Price Forbes Re. I'd like to welcome Pat. And Pat, I'd love, before we get going, for you just to introduce yourself and Price Forbes Re, please.
Thanks very much, Gerard. We're proud to be here and part of Peak again. I'm the CEO of Price Forbes Re US. This is a new operation for Ardana. This will be a full-fledged reinsurance brokerage in the United States. We'll handle traditional reinsurance as well as MGA and structured business. We have a few of our leaders already hired. We've been about a year in the process, and we're moving from strength to strength. So we're very glad to be part of the Peak Performance activities again, and also thank you for inviting us to speak today.
Well, we're delighted to have you and Price Forbes Re as sponsors today. Pat, this morning in my discussion, I argued, maybe somewhat provocatively, that if you're an MGA today, you might be better off being supported by a surplus lines carrier than by an admitted market carrier, mostly because the financial performance of the surplus lines carriers is that much more improved versus the admitted market carriers. And the statistics I quoted from AM Best suggested that there is a 15 percentage point differential between admitted market loss ratio, loss and LAE ratios of around 76, 77% versus the domestic professional surplus lines carriers that are in AM Best composite, which seem to be, as of the most recent data of 2023, showing a 62% loss ratio. Given that 15 percentage point differential has led me to conclude, at least in the near term, that for a number of reasons, if you are an MGA, you might be better off going with the surplus lines carriers that are supporting a much lower loss ratio. Do you agree? Do you disagree? What are your thoughts here on my somewhat provocative statement?
Well, I agree and disagree. There are different aspects to how we can use the surplus lines market, especially in the MGA world. We do agree with you in terms of the differential in loss ratio, and it's striking, especially this year. I do have some notes that I wanted to talk about here that give us some of the breakdown between what's happened in the admitted market and the non-admitted market. But last time I reported on this was back in 2017. After the Florida storms and all the wildfires, you saw a big spike then too to the surplus lines market. So this again happens after a lot of the natural catastrophes and maybe some of the non-modeled losses that we had that were unexpected by insurers and reinsurers over the last couple of years. Now that would be 23 and 22. So if you look at that, it also depends on the line of business. So if you'll allow me to take a look at a couple of the notes here so I get the numbers right. But you know, admitted and non-admitted are a customer's choice, and the agent always has to defer to what's right for his client, even on the primary side or the direct side. So when you talk about the difference, remember that an admitted company is supported by the state. They have to go through all the machinations to get the rates and forms and filings done, and that's a protection to the public. So when you say, is it preferred to offer a non-admitted policy versus an admitted policy? An agent usually will defer to an admitted policy because it's the best coverage that he can buy, and he can't be really criticized. It's in the state's looking after the company, and making sure that that company is solvent, and that most of the lines that are looked after by that by the department are in good standing for the public. That provides protection for the public. That is not to say that non-admitted insurers are something worse. They just perform differently. They're not under the supervision of the state. They come under the excess and surplus lines department. That's part of the Department of Insurance. But it's not. They don't file rates, and they don't have to look at policy form. As long as they're significantly capitalized and capitalized to the extent that they'll be solvent, then they're just as good as an admitted company. What you have on the admitted side is also you have the guarantee fund. Admitted companies have to deposit money into the guarantee fund, and there is a backstop. it doesn't cover all the losses if there's an insolvency, but it does help with the insolvency. Now, let's take a look at why we might think that the admitted market was, or the non-admitted market was, had such good results over the last year or two. I think what's happened is, I'll give you some of the statistics that I prepared for the talk today. The admitted premium in the United States is $963 billion versus $87 billion in the non-admitted space. The admitted space is dominated by auto. Of that 969, 383, almost 400 million of it is from auto, which is the largest line in the country. Next is property, and then you start to see GL and others as they decline. So that's the admitted side. You see on the non-admitted side, most of the premium is in the GL lines, where you're doing some significant, difficult lines of business, where the admitted or the non-admitted market is better in terms of what coverage, or at least the underwriting of that, and the property risks. Now you're starting to see some of the traditional lines even be done on a non-admitted basis, and that started back in the 2017 era, when we were seeing even homeowners come in as almost a non-admitted line. That has performed pretty well. I think what we saw in terms of loss ratio is in 2020, the non-admitted loss ratio spiked a little bit because we had some significant storm activity then, and some of the secondary perils over time really started to be problematic for the admitted and some of the non-admitted companies. But as a non-admitted carrier, you're able to take changes in coverage, deductible, exclusions in coverage. So you need, as an agent, so go all the way back down to that agent providing for his customer, you've got to decide whether that customer is insurance savvy enough to buy a non-admitted product and know what he's buying, as opposed to what might be dilution of market. It's the California wildfires. What's going to happen? How many companies are going to continue to do that? Or are they going to write this on a non-admitted basis? We saw it happen in all the storms along the coast. Lots of non-admitted coastal homeowners now, and there are also various tranches of what they're doing in non-admitted coastal. Some are doing it, from $750,000 to $1 million, and others are doing it from, $1 million up to $5 million. So there are different levels of categories and different distribution points. I see the non-admitted market as necessary because they do the higher value risks, they do the tougher stuff. And the admitted market is for the general consumer and for most personal lines. I mean, for auto, other than commercial auto, you hardly see, there isn't any non-admitted. For workers' comp, there isn't any non-admitted. I'll take a look at some, the property, and if we look at property, the loss ratios have plummeted for property for the non-admitted companies because of the ability for them to be able to underwrite and mitigate risk and pricing in their scheme. It has dropped also for the admitted companies in the most recent years, but really where it was difficult was the non-modeled losses and also some of the secondary perils during the COVID years. One of the things I looked at, which surprised me, was the number of riot losses there were and the aggregation of that number. And because I was looking at some of this just to prepare for this, I said, geez, look at all the riot losses. There are hundreds of them. And if you add them up, that's significant, and it's not usually modeled because it's secondary peril and not modeled accordingly. So as we see the non-admitted market perform a little better, people are starting to move to it. That's just what happened before in 2018. So they see it, they move to it. I'm not sure that will stay, because still the agent controls the business on the bottom end. If he can better offer an admitted product that's better covered by the state's insurance departments and also offers more coverage, that will trend backwards. So it is a matter of displacement of capacity, where there is a lack of capacity when the non-admitted market really thrives. So that's, I see that as, does an MGA have a better choice? I think it's segregated to the product line, and it's also segregated to timing. A lot of it has to do with catastrophe losses, and now we've seen secondary losses take everybody's attention, which is a new phenomenon for us. We looked at them, we knew they were there, we priced for them, maybe not priced enough for them. Social inflation continues to skyrocket. Commercial auto, still tough to make money at. But on other lines of business where you can control some of that, or at least exclude some of these prices, some of these exposures, or limit coverage to some of those exposures, you're able to make more money as an underwriting company.
Pat, I want to come back to just one thing you said there. And if I understood it right, you were basically saying that the agent needs to present to the ultimate insured the value of going with the E&S market, where there may be narrower coverage, it may cost more, and the like. But except for the most sophisticated insurance buyers, isn't it really the responsibility of the agent to be able to explain to the mostly unsophisticated insurance buyer the difference between going to the admitted and the non-admitted market, and why one, maybe it's the admitted, maybe it's the non-admitted market, is right for them? Isn't it really the responsibility of that agent?
Absolutely. That's why he carries D&O coverage and all the rest of it. You have an obligation to teach your client, get him the best product, make sure he understands, make sure he signs off on it as well. And if you're a good agent, you're talking about pricing, you're talking about what does it mean to you, what is your financial capability to absorb what's not covered in an E&S versus an admitted policy. So that counseling, and that is still the value of the independent agent. The counsel to the general public is still important. Believe it or not, I've been in this business my whole career. I still use an agent. I still talk with them. I ask them about coverage. What else do you have? And let's compare what is in the marketplace. That is, I think, a responsible buyer's for his own well-being, and also the agent to be able to probe from his customer what is best for you, and let me tell you why.
Pat Rastiello, thank you very much. Price Forbes Re, our new CEO.
Thank you,
Pat.
very much. Thanks, Gerard.
Thank you.
Appreciate it.